Today we're talking about day trading options, how you can day trade options and you can capitalize off 200, 300, 500, 600 to 1,000% returns on small amounts of money with the leverage and the power of options. Breaking it all down right here in a very, very cut and dry, straight up options for dummies type way in this video. So make sure you guys stay tuned. What's going on, guys? Patrick here, and today we're talking options. I've got a lot of people asking me questions about options. They want to know what options they should buy, how to buy options, and what is the difference between buying an option versus buying the stock. So it only made sense for me to make a video explaining exactly how I buy and sell options to make profit on stocks when they're either going up or they're going down. That's the great thing about options. You can buy calls when you believe that a stock is going to go higher, and then you can buy puts when you believe a stock is going to go lower in price. At the end of the day, puts can only go to zero. The stock price can only go to zero. So if the stock price is at $10 and you're buying $5 puts because you believe the stock price is going to end up below $5 by the end of the week, well, you only have that much room between $5 and zero. The difference between buying calls is that the upside really is infinity in terms of the possible potential. A stock can go from $1 to $1 million in theory. Not saying that it's going to do that, but it's possible compared to a stock going from $5 to zero. The lowest that a stock can go, the cap, the most profit that you can make on a put option is basically, to zero. So now that you understand the difference between calls and puts, let's talk about a trade today on FCEL, and I'll show you guys exactly how I went about it, what price, what strike, the dates, and all of that. Let's dive into it. All right, so here we go. Pulling up the Trader Workstation from Interactive Brokers is the platform that I'm using for trading options and trading in general investing. They have a really intuitive and very advanced mobile app as well. So if you're trading from your work or you're trading on your phone, buying options for swing trades, things like that, I would highly suggest checking out the Interactive Brokers mobile app. There's a link down below. You can learn more about Interactive Brokers. So let's dive into the chart here. So out of the gates, the market opens and FCEL goes, from the 620 area up there to a high of 750. I saw the momentum. We had green bars. We broke out over that pre-market high at that 630 area. So then I ended up buying call options on FCEL. So as you can see, this is the stock that we're looking at right now. This is just the 15-minute candlesticks showing the price of the stock on FCEL this morning, making that move. They had some news and they had momentum. So if we go over here now and we check out the options, we're going to look at, let's just pull up so you guys can see exactly the process. I'm going to pull up the options. So up top, it says September 17th, 21. That means that these options are going to expire on Friday, this upcoming Friday, September 17th. The next expiration is going to be September 24th, and then October 01. You can see how that works. Every other Friday, having those options expiring. So I need these options to be in the money to make profit, meaning I would need a $6 call option. Right now, the price of the stock is $6.38. On Friday, if the price of the stock is $6.38, those $6 call options will be in the money. But for me as a trader, I'm really trading it more so worried about the price action right now over what the price is going to be on Friday. If I'm swing trading, maybe a little bit different. I might be trading, but when it comes down to the actual day trading process of it, I'm looking for a call option that is very close to in the money or the next option right above in the money at that point, because I really want to find the options that have the volume and have the open interest in the movement so that I can get in and out and trade that option. So right now, like I said, the price of the stock is $6.38. I want to buy the options that are expiring the closest to this point. So September 17th is 3 days away. That's the options that I want to be trading if I'm going to be trading on a day trading kind of time frame, meaning, in the next 5, 10, 20, 30 minutes, I'm buying those options. So this morning when the price of the stock was around that 620, 630 area, you can see the next option that would be in the money after that $6 option would be $6.50. So I'm simply going to click here on that $6.50 option, and that's now going to pull up the chart. So this morning when the bell opens, you can see these $6.50 call options were 20 cents. down here, 20 cents, you could have bought these call options. The price went all the way to a high above $1.20. So you could have bought these call options for 20 cents, meaning you invested $20 in one call option, and then you could have sold that one call option for $1. Each call option represents 100 shares of the stock if you were to exercise that option. So a call option is basically giving you the right to buy that stock in the future at the current price or at the strike price that you're buying with the option. At the end of the day, if I'm buying $6 call options and then the stock price then goes to $8, $10, you can see how the premium then rises. So from a $6 call option, if the price of the stock is at around $8, you would normally have around a $2 premium there, as long as that volatility and the implied volatility and all that. It doesn't really matter for day trading. But at the end of the day, if I'm buying these 650 call options here at 20 cents when FCEL starts to break to the upside, I buy them for 20 cents. I can then sell them at $1. I'm then making a 3 to 4 times return on that money. We're really looking to play into momentum and volatility when trading these options. And we're looking for stocks that have a lot of volume, a lot of open interest, and a lot of action on them so that we can trade in and out. So like this one here, from the 20 cent area up there to $1, you had plenty of time to kind of take profit as it went up and then as it starts to break back down. But what we're really watching not is so much the options. We're not really so much worried about the price of the options going up and down here. We're focused on the price of the stock and the actual movements of the stock, because you can see pretty much as soon as this stock started to pull back here, now that we're looking at the actual underlying stock being FCEL, once it pulled back from that 750 area, that's exactly when that option started to go down in value. So really we're looking to trade the underlying stock being the FCEL, trading the actual stock, and then placing our trade through the option. So if I'm buying those 650 call options when the price of the stock is around 620 and then it goes to 750, I see that it's overextended at that point, then I'm maybe taking profit at that point. Really the nice thing about options is it's allowing me to risk a small amount of money for a larger return, whereas if I bought $20 worth of this stock, let's say I paid $20, I could buy 3 or 4 shares of the stock. It goes up $1, I'm only going to make $3 or $4. If I paid $20 for a call option that then goes to $100, I would then make $80 on that one call option. And the thing is, I can buy multiple call options. I can buy, hundreds of call options if I wanted to, depending on the options and the volume and the open interest. So that's one way to leverage that. And if you don't have a large account, you can trade with a cash account trading options. So you're allowed to basically trade in an account and get around kind of the PDT, because you'll have settled funds and it'll take a few days to get those settled funds back every time that you trade those options in settlement, and then you end up buying and selling. It's going to take a few days for that cash to get back into your account, but you can do this and you can get around the PDT rule, or the pattern day trading rule, being under $25,000. There's a lot of videos on YouTube talking about that, so I won't get too in depth, but I'm really focused on kind of what I'm looking for when I'm trading these options. And like I said, FCEL today made a big push to the upside. I looked at the options chain. I saw those 650 call options starting to make a move. I buy in there. We get the break over 630. We run up there to 750, and then you start to take profit as we push up there. And you can see those call options, literally, like I said, in a matter of minutes, we went from 20 cents to 40 cents to 80 cents to $1. So you can see how fast these call options move. So for my 20-cent call options, doubling, going up 100% in value in literally in only in about 15 minutes. So they went up 100% in value in about 15 minutes. And you can see the difference. The stock really only moved 10 to 20, 30%. Where with the options, you can have a 300% move in the options compared to the stock that only went up 20, 30, 40%. Where the options, you can really leverage the movement and the volatility depending on the movement. When you have a very strong upside trend, I prefer to trade the options, because I can basically look at the options chain and say, okay, $6.50, $7, $8. At the end of the day, I really don't care if the price of the stock goes to $9.50, if it goes to $9.58, depending on, owning the stock, but I'm really looking at just the overall volatility of those options and making that move. So like today, like I said, that move from the 20-cent area to 120, I mean, that's a beautiful move there. And you're able to really capitalize off that volatility compared to trading the stock. And when the stock only went up 10, 20%, you had options that went up 300%. So you can see the opportunity here to trade options. And like I said, you can trade options with a small account. You can trade options in a cash account. And now with most brokers, you're paying very low fees as well with the options. So there's really a lot of opportunity to trade options. And I wanted to kind of talk about what I'm looking for. And the thing is, it kind of works exactly the same. So let's say FCEL starts to gap down on the day, or we'll look at I think BBIG or ATER. Let's look at ATER. That'll be a good one to look at. So we're going to go to ATER, look at the stock first thing here. And you can see ATER has been selling off since open. So from $16.50 down to $11. So let's say at open you ended up buying $15 puts, because you look at it like, okay, we got this $15 level. I believe if $15 cannot hold, that we'll see, $10 to $11 on that option or on that contract, well, on the stocks. I'm going to look at the options chain, and I'll show you exactly what you would have done if you're looking to short this, thinking the price is going to go lower. So at open, let's say, okay, we're right at $16, we're right at $15. I'm going to look at the puts that are expiring on September 17th, being this upcoming Friday. Now, if I wanted to have, a little bit more wiggle room, I might be able to do the 15th on October call, so I'll have a whole month to have a little bit more wiggle room there. But at the same time, I'm fighting time. So that's one thing you have to remember with options, is you're getting a leveraged product. Basically, you're getting this option to basically buy the stock, but you're paying a premium, and then you're also fighting time decay with the implied volatility in the overall option possibly going to zero, because 90% of options end up expiring worthless. So when you're day trading, this really doesn't apply, because you're not really holding these options for a long time. You're really looking to capitalize off of these moves in the short period of time. So let's look at the $15 call options. Like I said, this morning we had the stock price around $16 to $15, and let's say that you believed that you think the price of ATER is going to go down today. So as you can see, we open up. Remember, options don't trade after hours, so when you look at the options charts, it's only going to be between 9:30 and 4. So we can see here we had almost like a little bull flag on these options there. ATER this morning from the $1.90 area all the way to a high of $4.80. You had that massive move to the downside here on ATER, and you could have made some big profits here as well. So you're basically buying these $15 puts, believing the stock price is going to go lower. You pay $1. Let's just say you pay $2 for these options, and then the price goes to $4. You have now made a 100% return. So you're going to end up paying $200 for these options. You're going to pay $200 per one option contract. If it goes to $4 in value, then you would have a $400 value on that call option. You would then make $200 in profit off of that move. So you're only risking $200 here, and you're not really risking a full $200, because you could play this basically as like, okay, I'm going to buy the puts here at $2. My overall stop is going to be around that $1.50 area, meaning the stock of the price of the stock on ATER. Again, remember, we're trading the stock, not so much the option, but we're trading. If this ends up bouncing and going above $16.50, that's going to be my stop loss. But if this breaks below 15, I believe that option would then rise in value, and that's exactly what happened here on ATER today. So that's really the way that I'm trading these options instead of trading the stock. Again, so if I had $200 and I bought 25 shares of ATER and the stock price dropped $5, I would then make $50 in profit. Whereas with the option, I would put $200 in, and then I would make $200 in profit if it went to $4. It actually went all the way to $4.80, so almost $5. It might actually get there. It's up to the $4.75 area right now. So you can see how much opportunity there is to trade the options. And again, you can have a small account. You don't need a ton of money. You can trade with a small amount of money. You can trade in a cash account, and you can do it all, pretty much just like I'm doing here. Trading these daily options and trading the volatility. The one thing that I want to stress, as always, guys, is there's obviously going to be volatility. If you're trading something like this that's going to go up 200, 300%, well, there's also a chance that it could crash 50%. So, I'm putting in $200 on a call option, and I'm basically risking, 30 to 40%, I would say, or maybe a little bit more. I would say like 50% would be my kind of final stop, because the way that I'm trading this is basically, okay, if I lose 50% on this trade, but on the next 2 or 3 trades, I make 300, 400, 500%, well, then that really eats up any type of small losses that I have. So that's the one thing that I want to stress with options. And another thing with options is I would never be averaging down, because you just cannot go and add and add and add, because at a certain point, these options could expire worthless or really worth nothing. So the idea of just buying and buying and buying and adding and adding and adding, it just really doesn't work long term. You really have to understand how these options work and understand the volatility and the overall IV and all that. So when it comes to day trading the options, you're not so much worried about the IV. You're not worried about all that. When it comes to longer term trades with the options, then you're more worried about the IV and all of that. And you can do your research on that. But when it comes to actually trading the options, I believe it's really simple and easy to see the setups and to capitalize off of those setups when they happen. So there it is, trading options, interactive brokers. If you want to learn more, there's a link down below. Do me one big favor, hit that like button, subscribe button, all the buttons down below. And that's exactly what I'm doing when I'm out here trading options, baby. I'll talk to you guys later.